Hello everybody, thank you all for joining me today. I've been really looking forward to speaking to you all on this subject, buy-to-let mortgages for limited companies, as not only is it an area which I do a huge amount of work in, but it's also one in which I have personal experience, and thus I feel that I can talk to you with absolute authority. By way of an agenda, we're going to cover off why people are increasingly using limited companies as the ownership vehicle for their properties. And then we're going to run through the pros and cons of limited company borrowing versus personal borrowing. After this, we're going to discuss how you actually set up the company and the peculiarities around this. And then we will move on to the most asked questions about limited company borrowing. This should take us around half an hour, and I will ask that you save any questions for the end. You'll see at the bottom left of your screen a place where you can type your questions in, and I will do my best to answer them. Hopefully, by the end of our session today, I will have covered off all that you need to know, but as well as questions at the end of the session, you're always very welcome to get in touch with us directly. First up, I'd really like to just introduce myself properly. My name is Jeni Browne and I'm a sales director here. I've been a mortgage broker for the last 20 years and I've worked at Mortgages for Business for 13 of these. As well as this day job, I have 2 buy-to-lets, one held personally and one in a limited company. The latter was purchased in the run-up to the stamp duty changes, which came into effect 3 years ago this coming March. So, as well as having a working knowledge of this part of the market, I also have some very real personal experience. So I hope that you will feel that you are investing your time wisely today and that you're in very good hands, at least for the next half an hour. So why is limited company borrowing becoming so popular? It all started, like Brexit, under the Cameron-Osborne rule. On the 8th of July 2015, George announced the progressive restriction of tax relief on mortgage interest and other finance costs to the basic rate of tax starting 6th of April 2017 to the 5th of April 2021. In very broad terms, what this means is that landlords will be able to offset less costs against their rent and their tax bill will increase. This is being phased in over a period of a few years, and we're smack bang in the middle of this right now. This slide illustrates what this means to the landlord in monetary terms. Simply put, pre-changes, rental income of £15,000 gross for a high-rate taxpayer would mean a taxable profit of £4,288 compared to £2,718 in 2021, i.e. a whole lot more tax would be due. While some landlords have the bandwidth to withstand this, others will unfortunately find themselves in a position where the property generates minimal, no, or even in some cases, a negative profit. Because these changes were not applied to limited companies, it became quickly apparent that using a company structure to own properties would be more tax efficient for many landlords, and thus the limited company buy-to-let market went into growth mode in a big way. This market has always existed, but the benefits of using a limited company was only beneficial to a few, so it has always been very small. The tax changes have meant that around 80% of our purchase business is now for limited companies rather than individuals. As the decision to use a limited company structure is always linked to tax, the best advice I can give you is to speak to a tax advisor or accountant. What we're going to cover off now is how to set up limited companies. So once you've made the decision that the company route is the way to go, the first thing you're going to want to do is actually set up the company. There is a plethora of companies advertising online offering a service where they will do this for you, but they charge money for this, and in some cases it's a large amount of money. I set my company up myself. I simply went onto the Companies House website and paid about 20 quid and spent about 20 minutes filling out the form, of which around 17 minutes was spent trying to decide what to call the company. I would add, you can call the company whatever you like, it makes no odds, although I would suggest that you keep it clean. So I filled in the form and the company was up and ready to go 48 hours later. Really easy stuff. I would say here that mine was a very simple structure. I'm the company director and I own all of the shares. Most cases we see have this or 2 directors, typically a husband and wife, who own the company 50-50. We do also see more complex versions of this with various shareholding percentages and classes of shares. Later on I'll tell you a little bit about what lenders like to see, but ultimately it's probably worth chatting it through with an accountant if you aren't sure how to structure this. Okay, so this is a really good time to talk about SIC codes or Standard Industry Classification Codes, and actually what is an SPV. So an SPV is an industry term which is used to describe a company which is set up just to let out property. In the industry, we refer to a company that does anything other than just letting property as a trading company. All limited company lenders will lend to an SPV, but only some of these will lend to a trading company. If you are setting up a new company, to ensure that your company is accepted as an SPV, you will need to, once it's registered, call Companies House and tell them that you want to allocate the SIC codes to your company. You'll want to use one or all of the following: so 68100, 68201, or 68209. The SIC code essentially lets Companies House know what your company does, but it does not dictate what it can do. So you could say that your company lets property and give it the relevant SIC code, but then do a bit of an IT consultancy through the business as well. The SIC code doesn't preclude that from happening. However, in the future, if you were to do this and then apply for a limited company mortgage and the lender looked at the company accounts and they could see revenue stream coming through your books that weren't just from property letting, they would then regard the company as a trading company rather than an SPV. However, when you set up a new company, the SIC codes mean that when a lender looks at your company information when you apply for a mortgage, it will clearly state that your company is set up just to rent out property. Some lenders insist on this being in place when you apply, although you don't actually have to register an SIC code until your company's first return, but others don't. So for completeness, you may as well do this early doors to avoid any possible issues. The other thing it's worth starting on when you set up the company is your bank account. You're going to need a business bank account to run alongside your company, and from my experience, this is quite lengthy in terms of how long it takes. When I research which banks to use, you will find that there are lots of incentives, for example, no transaction charges for the first 2 years. My view, and this is just me, is that these all come out in the wash and one is much the same as the other. So I went with NatWest as I had a branch by the office. It took me a good few weeks to get this set up. I'd point out here that you can actually apply for a mortgage without the bank account in place, but the lender can't produce the mortgage offer without it. So again, it's worth getting this sorted up front so you don't have any delays down the line. So we have a new company and we have a bank account. But what if you have a company already, a trading company, and are considering using this to buy a property instead? My first question to you would be why you would want to use a trading company rather than set up a new SPV. If the answer is that you simply don't want the hassle of having another company to produce accounts for, then that's fair enough. But if it's that you have funds in the trading company and if you withdraw them to put them back into a new company, you worry this will trigger a tax bill, it's worth you knowing that actually there are ways to move the money from one company to another without a tax being an issue, all wholly legal and acceptable. One thing just to be wary of if you do decide to borrow through a trading company is whether the lender you go to will want a debenture over your company. In my experience, borrowers don't tend to want a lender to take a charge over the company, which is what pays their income, so be sure to check this out up front. The benefits to my mind of setting up a new company rather than borrowing through your trading company is that firstly, it does keep things separate, but also there are simply more lenders who will lend to an SPV than a trading company, and this invariably means that more choice brings better interest rates. If you wanted to compare the two, one of our brokers would be very happy to run through the cost of both so you can see how this lands in real terms. Okay, so back to our new SPV that we've just set up. Why would a lender be willing to offer a mortgage to a brand new company with no track record? And this is one of the questions I get asked the most. The answer is that the lender, whilst absolutely lending to the company, are actually hanging their hat on the people who own or run the company. So what lenders do pretty much every single time is take what's called unsupported personal guarantees from the company directors and, depending on the lender, all shareholders with a shareholding of more than 20% or above, or sometimes it's just the directors. The personal guarantee means that if the lender has to repossess the property and sell it on, and there's not sufficient money from this to clear the debt, then those who have offered the personal guarantee are liable for the shortfall. And this is the same as if you were to buy the property in your own name. Because of this, the mortgage application is really focused on these people rather than the company itself. And because of this, they can get comfortable with lending to a brand new company. The people who are offering the personal guarantee will normally need to meet the lender's criteria as per a traditional buy-to-let application, or at least one of them would have to if you had multiple people. Broadly speaking, and there are always exceptions to this, they need to own a property already, have a clean credit profile, and have some form of income. Some clients will have, for example, their children as shareholders or a non-working spouse as a company director. These are things we can generally work with, and every case is different, but I would suggest that before you set up your company, it's worth chatting to a broker to check that the people who sit behind the company and its structure will not preclude you from getting a mortgage. Okay, so buy-to-let mortgages for limited companies and applying for these. Deposits are also worth a few moments of your time to run through. If you're taking money from your own personal resources, then you will get this into the company as a director's loan. If you're selling one of your personally held properties into the company, then the equity in this property would also form a director's loan. Director's loans can be repaid to you by the company when the company has sufficient profit to allow this to happen, and as it's a repayment of a loan, there's no tax on this. If you have a trading company, you can get the money into the new company either by an intercompany loan or by making the trading company a shareholder, and this is something you really want an accountant to run through with you. Most of the company mortgages we do are at 75% loan to value. However, you can borrow up to 85%, although this becomes quite expensive. And the cheapest pricing, just so you know, comes in when you borrow 60% loan to value or below. Okay, so our company is set up. It's structured in a way that means we can get a mortgage. We have a bank account and we have our deposit. One last thing to really mention here is solicitors. Lenders who lend to limited companies generally have a panel of solicitors whom they are comfortable using for their conveyancing work. The panel for some lenders is just a couple of legal firms, and for others it's a large number of companies. For the lenders who operate on this basis, you can use one of these solicitors on the list and they can act for both you and the lender. However, if you want to use a different firm, that's fine, but the lender will still insist that a firm on their panel represents them. The downside of this is twofold. Firstly, you'll need to cover the cost of the lender's solicitor and your own, which can get quite expensive. The other thing is that when you have an additional solicitor in the mix, which can make matters slower, so it's not always a good thing if you need to progress the transaction quickly. Lastly, some limited company lenders will always insist on having their own firm acting for them and you having separate legal representation. It's always worth asking the question up front as to what the lender you're using needs so you don't get any nasty surprises down the line. Okay, and now we're going to move on to some of the frequently asked questions that we get. Are limited company mortgages more expensive than personal ones? Now, in broad terms, when looking at the very vanilla end of the market, then yes, they are. However, this gap is closing. I'd also just say that if you are buying an HMO or a block of flats, then more often than not, that difference is negligible, if non-existent. The lenders who operate in the limited company market tend to also do the more complex property types, and they don't tend to price differently between limited company and personal. The best thing to do, if you aren't ever sure, is to ask for a quote for both personal and limited company so you can compare them side by side, whilst of course keeping in mind the tax implications. Do limited company mortgage applications take longer than personal applications? The lenders who offer mortgages to limited companies will bring in manual underwriting, so what I mean by that is humans, into their process at some stage. If you borrow personally, there are a couple of lenders who can run the whole process by computers. So yes, comparing these two would mean the limited company offering would be a little slower. However, this really is taking the extreme examples, and by the rule of thumb, I say that realistically you'd expect to add 2 to 3 days for a limited company application. So a little bit longer, but nothing drastic. Can I put my current buy-to-lets into a limited company? So yes, you can do this as long as it's done as a purchase. We recently did a very good article on this, and it will be sent to you after our session, so you can read about this separately. Also, I just wanted to say that we're going to send you a link to my blogs about buying a buy-to-let through a limited company and beyond, which has proved to be incredibly popular, plus a tax calculation spreadsheet, so you can do some playing around with the numbers to see how the tax changes will impact you personally and see how the limited company option may help. Also, I just want to add here that we see a lot of people who want to sell their current home to a limited company and then purchase a new main residence. This allows them to retain their current home as an investment, but also, assuming they have no other buy-to-lets, pay stamp duty without the surcharge on the new purchase. This can be incredibly beneficial, particularly if you're upsizing with the new home. Does the company have to pay the stamp duty surcharge? Sorry, but yes, every single time a company buys a property, whether it's the first property the company owns or not, by the very virtue that you're using a corporate structure, then yes, the surcharge of 3% absolutely applies. Do limited company lenders offer fixed rate deals? And the answer to that is yes, absolutely. What you'll find is that when you look into limited company buy-to-let mortgages, you're going to be met with a suite of products. So 2, 3 and 5 year fixed deals, variable deals, deals with no exit fees and so on. They're all on offer. Likewise, most limited company lenders have a set of products which they offer to existing borrowers when the initial rate ends. So you don't necessarily have to remortgage to a new lender every time your deal comes to a close.